Bookkeeping involves recording daily transactions in the accounting cycle, such as entering customer invoices and paying vendor bills. Bookkeeping also carry out routine tasks and calculations, such as running payroll and doing the bank statement reconciliation. In this course, Getting Started with Bookkeeping, we walk you through the basics of bookkeeping, including the rule of debits and credits, and why proper debiting and crediting keep the financial statements in balance. You also learn the 5 steps for entering transactions into the accounting records. Financial accounting is a double-entry system. For every entry into the company accounting records, there has to be an opposite and equal entry. In other words, debits must always equal credits. The fundamental accounting equation proves that all transactions are equal and opposite. It demands that assets equals liabilities plus owner's equity. A truncated version of this equation states net assets equals owner's equity. Before we go any further, we need to define our cast of characters in this equation. Number 1, assets. Assets are resourcing a company owns. Some examples are cash, equipment, and cars. Number 2, liabilities. Liabilities are debts the company owes to others. The biggie liabilities you encounter in your financial accounting class or at work as a financial accountant are accounts payable and notes payable. Number 3, owner's equity. Owner's equity is what's left over in the business at the end of the day, a company's assets minus its debts. Many financial accounting courses define owner's equity as the owner's claim to the company's assets. Before you enter an event into a business accounting system, you have to consider the transaction methodology, a 5-step process for deciding the correctness of whatever entry you're preparing. After you get into the financial accounting rhythm, this becomes an automatic analysis you do by rote. Here are your 5 considerations. Number 1, what's going on? This question addresses the precipitating event for the entry. For example, did the company buy a new piece of business equipment or sell some product to a customer? Number 2, which accounts does this event affect? Is the account an asset, liability, owner's equity, revenue, or expense? Assets would definitely be affected by the purchase of business equipment, and revenue would be affected by a customer sale. Number 3, how are the accounts affected, by debit or credit? Looking back to your rules of debits and credits, buying assets adds to the account, so it's a debit. Making a sale adds to a revenue account, so it's a credit. Number 4, do all debits for an entry equal all credits for the same entry? Think about the fundamental accounting equation. For every debit, there has to be an equal credit. Number 5, does the entry make sense? Do the actions you take to match the facts and circumstances of the business event? For example, although the net effect on the books is the same, you can't credit an expense to record revenue. Accounting journals are a lot like the diary you may have kept as a child. They are a day-to-day recording of events. But accounting journals record business transactions taking place within a company's accounting department. Accountants call journals the books of original entry because no transactions get into the accounting records without being entered into a journal first. A business can have many different types of journals. In this section, you learn about the most common ones your financial accounting class discusses, which are tailored to handle cash, accrual, or special transactions. All transactions affecting cash go into the cash receipts or cash disbursements journal. Some accounting software programs or textbooks may refer to the cash disbursements as the cash payments journal. Here are examples of some cash events that require posting to the cash receipts journal. Number 1, customer sales, made for paper money and coinage. Many types of businesses still have booming cash sales involving the exchange of paper money and coins. Some examples are convenience stores, retail shops, and some service providers, such as hair salons. Number 2, customers making payments on their accounts. We talk about accounts receivable, which is money customers owe a business. Just remember that any payment a customer makes for goods or services previously billed goes in the cash receipts journal. Number 3, interest or dividend income. When a bank or investment account pays a business for the use of its money in the form of interest or dividends, the payment is considered a cash receipt. Number 4, asset sales. Selling a business asset like a car or office furniture can also result in a cash transaction. You may see an example in your textbook where a company is outfitting its executive office space with deluxe new leather chairs, so it's selling all the old leather chairs to a furniture liquidator, and there is an exchange of some mode of cash between the parties to the sale. The cash receipts journal normally has 2 columns for debits and 4 columns for credits. Number 1, debit columns. Because all transactions in the cash receipts journal involve the receipt of cash, one of the debit columns is always for cash. The other is for sales discounts, which reflects any discount the business gives to a good vendor who pays early. For example, a customer's invoice is due within 30 days, but if the customer pays early, it gets a 2% discount. Number 2. Credit columns. To balance the debits, a cash receipts journal contains 4 credit columns: sales, accounts receivable, sales tax payable, and miscellaneous, which is a catch-all column, where you record all other cash receipts like interest and dividends. In addition to the debit and credit columns, a cash receipts journal also contains at least 2 other columns that don't have anything to do with debits or credits: the date the transaction occurs and the name of the account affected by the transaction. On the flip side, any payment the business makes using a form of cash gets recorded in the cash disbursements or payments journal. Here are a few examples of transactions you see in a cash disbursements journal. Number 1. Merchandise purchases. When a merchandiser, a company selling goods to the public, pays cash for the goods it buys for resale, the transaction goes in the cash disbursement journal. Number 2. Payments the company is making on outstanding accounts. This includes all cash disbursements a company makes to pay for goods or services it obtained from another business and didn't pay for when the original transaction took place. Number 3. Payments for operating expenses. These transactions include checks or bank transfers a business uses to pay utility or telephone invoices. The cash disbursements journal normally has 2 columns for debits and 2 for credits. Number 1. Credit columns. Because all transactions in the cash disbursements journal involve the payment of cash, one of your credit columns is for cash. The other is for purchase discounts, which are reductions in the amount a company has to pay the vendor for any purchases on account. For example, a business offers customers a certain discount amount if they pay their bills within a certain number of days. Number 2. Debit columns. To balance these credits, the debit columns in a cash disbursements journal are accounts payable and miscellaneous, a catch-all column where you record all other cash payments for transactions, such as the payment of operating expenses. A cash disbursement journal also contains at least 3 other columns that don't have anything to do with debiting or crediting: the date the transaction occurs, the name of the account affected by the transaction, and the pay-to entity, which means who the payment is made to. Accrual transactions take place whenever cash doesn't change hands. For example, a customer makes a purchase with a promise to pay within 30 days. Using accruals and recording business transactions using the accrual method is the backbone of financial accounting. The following is information about your 2 accrual workhorse journals: the sales journal and purchases journal. Number 1. Sales journal. The sales journal records all sales that a business makes to customers on account, which means no money changes hands between the company and its customer at the time of the sale. A sales journal affects 2 different accounts: accounts receivable and sales. In the sales journal, accounts receivable and sales are always affected by the same dollar amount. Number 2. Purchases journal. Anytime a business buys using credit on account, it records the transaction in its purchases journal. The purchases journal typically has a column for date, number, and amount. It also has the following columns. Number 1. Accounts payable. Because the company is purchasing on account, the current liability account called accounts trade payable is always affected. Number 2. Terms. This column shows any discount terms the company may have with the vendor. Number 3. Name. The company records the name of the vendor from whom the purchase is made. Number 4. Account. This column shows to which financial statement account the purchase is taken. Here are 3 additional journals you'll encounter. Number 1. Payroll journal. This journal records all payroll transactions, such as gross wages, taxes withheld, and other deductions, such as health insurance paid by the employee, leading to net pay, which is the amount shown on the employee's check. Number 2. Purchases return and allowances journal. This journal shows all subtractions from gross purchases because of products a company returns to the vendor or discounts given to the company by the vendor. Number 3. Sales returns and allowances journal. This journal shows all subtractions from gross sales because of products customers return or discounts are given to the customers. The general journal is a catch-all type of journal where transactions that don't appropriately belong in any other journal show up. Many companies record interest income and dividends in the general journal. This journal is also used for adjusting and closing journal entries. Number 1. Adjusting journal entries. One key reason you would adjust journal entries is to make sure the accounting books are recording using the accrual method. Number 2. Closing journal entries. You use this type of entry to zero out all temporary accounts, which reflect all the revenue and expenses for a certain time period. You then transfer the net amounts to the balance sheet. You take this step to set the income statement figures to zero so you know exactly how much revenue and expense are booked during a certain time period. There are 4 closing journal entries. Number 1, you debit all revenue accounts and credit income summary for the same amount. Income summary is a temporary holding account you use only when closing out a period. Number 2, you credit all expenses and debit income summary for the same amount. Number 3, you either debit or credit income summary to reduce it to zero and take the same figure to retained earnings, which is the cumulative net income that has not been distributed to the owners of the business. Number 4, if the owners have paid themselves any dividends during the period, you credit the dividend account reducing it to zero and debit retained earnings. The ledger records applicable transaction taking place in a company during a particular accounting cycle. Picture a big book. Every page of the book has a title that corresponds with an account from the chart of accounts. For instance, page 1 may be titled 1001 Cash in the Bank. On this page, you'd list the total of the funds you deposited in your company checking account, as well as the total of all the withdrawals for a given period, say for a month. A business has one big ledger. The general ledger. The general ledger lists all transactions taking place in all the accounts during the specified accounting period. You may also see subsidiary ledgers that list in detail transactions happening only in specific accounting circumstances. For example, the payroll subsidiary ledger lists all payroll transactions. The accounts receivable subsidiary ledger lists all customers owing your company money and the amount of their current outstanding balance. When you post to the ledgers, you simply take accounts and numbers from transactions you enter in the journals and record them in the correct ledger. If a subsidiary ledger is the first point of recording, the transaction eventually flows through the subsidiary ledger to the general ledger. For example, a customer sale on account first posts to the sales journal and then is reported in the accounts receivable subsidiary ledger under the customer's name. Then, that amount flows from the accounts receivable subsidiary ledger to the accounts receivable listing in the general ledger, combining with all other customers owing the business money to show a grand total of accounts receivable. Following with the same transaction, the combined total of all the transactions in the sales journal also posts to the sales listing in the general ledger.